The 2008 financial crash, also known as the global financial crisis, was one of the most severe economic downturns in modern history. This event triggered a deep global recession, impacting economies, jobs, and financial institutions worldwide. Understanding its causes and consequences remains crucial for navigating today's financial landscape. We will explore the factors that led to the crisis, the timeline of the collapse, and the lasting lessons learned. The origins of the crash can be traced back to a massive housing bubble in the United States. Between the late 1990s and 2006, U.S. home prices rose at an unsustainable rate. This created a widespread belief that real estate was a fail-safe investment. This perception fueled speculative buying and risky lending practices. A key factor was the proliferation of subprime mortgages. These were high-risk loans extended to borrowers with poor credit histories. Lenders offered these mortgages with low initial interest rates that would later reset to much higher levels, making them difficult for borrowers to repay. This strategy was profitable as long as housing prices continued to climb. The risk from these mortgages was packaged and sold to investors through complex financial instruments, mortgage-backed securities, or MBS, bundled thousands of individual mortgages together. These bundles were then sliced into tranches and sold as securities, with investors receiving payments as homeowners paid their mortgages. This process appeared to spread the risk, making the investments seem safer than they actually were. Another layer of complexity came from collateralized debt obligations, or CDOs. These instruments bundled various assets, including the riskiest tranches of mortgage-backed securities. Rating agencies often gave these complex derivatives high credit ratings, misleading many investors into believing they were low risk. This encouraged widespread investment in assets that were fundamentally unstable. Financial institutions amplified the danger by using high leverage. Banks and investment firms borrowed massive amounts of money to invest in these mortgage-related securities. This strategy maximized their potential profits, but also exposed them to catastrophic losses. If the value of the assets fell, they were essentially making huge bets with borrowed funds. Finally, significant regulatory failures allowed these risky practices to continue unchecked. There was insufficient oversight of the subprime mortgage market and the complex derivatives that fueled the crisis. Government policies promoted home ownership without adequate safeguards, while regulators failed to recognize the systemic risk building within the financial system. This lack of supervision created an environment ripe for collapse. The turning point came when the housing bubble burst. Beginning in 2006, U.S. housing prices started to fall, leaving many homeowners with mortgages worth more than their homes. As the adjustable rates on subprime mortgages reset, many borrowers could no longer afford their monthly payments. This triggered a wave of defaults across the country. The surge in mortgage defaults caused the value of mortgage-backed securities and CDOs to plummet. Major banks and financial institutions that had invested heavily in these assets suddenly faced enormous losses. Their balance sheets were filled with toxic assets that were now nearly worthless. This eroded their capital and pushed them toward insolvency. The crisis reached a dramatic peak in September 2008 with the bankruptcy of Lehman Brothers. As one of the largest investment banks in the United States, its collapse sent shockwaves through the global financial system. The failure of Lehman Brothers signaled that no institution was too big to fail, creating widespread panic among investors and financial institutions. This event triggered a severe credit crunch. Banks grew terrified of lending to each other, unsure which institutions were solvent and which were on the brink of collapse. Credit markets froze, making it nearly impossible for businesses and consumers to get loans. This lending paralysis brought economic activity to a grinding halt. The financial collapse quickly spread beyond the United States, leading to a global crisis. Stock markets around the world crashed as investor confidence evaporated. Major indices in Europe and Asia experienced dramatic declines, wiping out trillions of dollars in wealth. The interconnected nature of the global financial system meant that the U.S. crisis became a worldwide problem. The credit freeze had a devastating impact on the real economy. Businesses, unable to secure loans, were forced to cut back on investments and lay off workers. Consumer spending plummeted as households faced job losses, falling home values, and tighter credit. This sharp decline in demand pushed economies into a deep recession. The human cost of the crisis was immense. Millions of people lost their jobs as unemployment rates soared. In the United States alone, millions of families lost their homes to foreclosure. The crisis plunged countless individuals into financial hardship and poverty. In response, governments around the world intervened with unprecedented measures. They implemented massive bailout packages to rescue failing banks and financial institutions, such as the Troubled Asset Relief Program (TARP) in the U.S. Central banks also injected liquidity into the financial system and cut interest rates to historic lows to stimulate lending and economic growth. These stimulus packages aimed to prevent a complete collapse of the global economy. The 2008 financial crash taught several critical lessons. It highlighted the profound importance of robust financial regulation and effective oversight. The crisis demonstrated that unregulated markets can create systemic risks that threaten the entire economy. A lack of supervision allowed financial institutions to take on excessive risk without consequence. The events also exposed the dangers of high leverage and speculative lending. Banks that had borrowed heavily to invest in risky assets were the first to fall. This underscored the need for stricter capital requirements to ensure that financial institutions can absorb unexpected losses. The crisis showed that relying on borrowed money to chase high returns is a recipe for disaster. Furthermore, the crash revealed just how interconnected the global financial system is. A problem that started in the U.S. subprime mortgage market quickly spread across the globe. This taught regulators and policymakers that financial crises are no longer local events. International cooperation is essential to manage and prevent systemic risks that cross borders. In the aftermath, governments enacted significant reforms to prevent a repeat scenario. The most notable in the United States was the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010. This comprehensive legislation aimed to increase transparency, improve accountability, and end the idea that some firms are too big to fail. It established new agencies like the Consumer Financial Protection Bureau to protect consumers from predatory lending. In conclusion, the 2008 financial crash was a devastating event with complex causes, a dramatic collapse, and far-reaching consequences. It stemmed from a combination of a housing bubble, risky lending, complex financial products, and regulatory failures. The crisis serves as a powerful reminder of the inherent risks within the financial system and the importance of responsible governance. Understanding this history is essential for building a more stable and resilient global economy for the future.